We begin with the big mover after hours. Disney's thinking after reporting an earnings miss. Let's get straight to Julia Boorstin, who's got all the details. Julia.
Well, Melissa, in his comments on the call, Disney CEO Bob Iger stressing that the lower than expected results in the quarter are really the result of the big changes that he has implemented at the company, both the Fox acquisition and Disney's pivot to embrace the streaming direct-to-consumer business, which they're investing in so much right now. Now, Iger just announced that consumers will be able to subscribe to a bundle of their services for $12.99. They'll get Hulu, ESPN, and Disney+. Worth noting that's the same cost as Netflix. Take a listen to his comments here.
And our results reflect our efforts to integrate the assets, businesses, and talent we acquired in order to enhance and advance our strategic transformation. Implementation of our integration plan is well underway, a complex process given the magnitude of the endeavor, and we remain confident in our ability to successfully execute our strategy.
CFO Christine McCarthy is saying that the acquisition of 21st Century Fox and taking control of Hulu will have a dilutive impact on the fiscal fourth quarter of about 45 cents per share, but saying that they are still on track for that acquisition to be accretive to earnings in fiscal 2021. Iger stressing throughout his comments that the company's next leg of growth will be driven by the value of their new content library.
We're also focused on leveraging Fox's vast library of great titles to further enrich the content mix on our DTC platforms. For example, reimagining Home Alone, Night at the Museum, Cheaper by the Dozen, and Diary of a Wimpy Kid for a new generation on Disney+.
Now, and speaking of Disney+, the company saying that its streaming losses will rise to $900 million in the fourth quarter. Also want to touch on the lower than expected results at Disneyland, the Anaheim park. Iger saying that there was so much concern about crowding around the launch of the Star Wars land, the Star Wars Galaxy's Edge land, that kept people away, both those crowding concerns as well as the fact that ticket prices were higher and also hotels in the region raised their prices around that launch. But he said long term they're not concerned because guest satisfaction is high and they're looking forward to the launch of the second ride. The fact that it opened with only one ride may have also weighed on keeping those fans away. Guys, back over to you.
All right, Julia, keep us posted on the conference call. Julia Boorstin in Los Angeles for us, at Disney, actually. Let's trade this. This is tough because the Fox integration makes year-on-year comparisons difficult. One area that's tough, so Studio, for instance, Avengers, which was Guy's favorite movie, was released alongside Dark Phoenix. Well, that too.
Sorry.
But so you had the success of Avengers, the flop of Dark Phoenix, and that makes things tough.
Now, and I think the court, if this Disney Plus launch date, November 12th, I think it is, if they didn't announce that, the $12.99, the bundle, I think the stock would be down a lot more. You have to admit, the stock has traded remarkably well since the end of April. When it traded up to 140, it's basically gone sideways to slightly higher ever since, on what at least recently has been a pretty dicey tape. The problem I have continues to be, and we can debate it, but at 22 times forward earnings with no real tremendous earnings growth, at least that I see over the next year or so, this stock is expensive. By any metric you look at, in my opinion, it's expensive up here. With that said, I never thought it'd be up here in the first place.
$12.99 is the same cost as Netflix.
Look, I think it's a major competitor. Look, the Fox content is something that's a complement to content that there's a big argument outside of studio what they're actually doing that's of value. I think maybe one of our guests who's coming on might have a view on that, so we'll leave that for him. My view is, first of all, to address Guy on the valuation, think of some other big brands out there with no growth. Think of Starbucks, think of Coke, think of Walmart. Disney's got better growth. The bottom line here is after April, you have started to be able to value this company on a different multiple. Look, streaming companies, he talked about losses and investment. Netflix doesn't make money. And look at the multiple on that company. You should not be penalizing Disney for investing in this part of their business. I don't know how many subs they're going to pick up, but at some point the street has to value this company differently at 23 times, which is a premium multiple to itself, but nowhere near the big boys. This is a $150 stock at very, I think, easy comp on 20 numbers.
I think the key question here is, don't we need to to give a streaming multiple for part of Disney's business at this point. And so what does that take Disney up to?
I don't know. Is it already up to it already? Right? There is
That's
some
a big
streaming
question,
multiple
yeah.
in there already. There's no question about it. Remember how excited people got when they first announced, and it was that $7 to $6.99. That was worth a lot of money to it. I mean, I think it's Disney. It's a premier company. It's a really lumpy quarter. You never know with the merger. That gives you a lot of opportunities to kind of, I don't know, play with expenses, charges, whatever. It is a premier company, though. The only thing that's not expensive compared to is Netflix. It's not even obviously anywhere remotely close to where Netflix is trading. So I don't know. I think they get a pass.
I just kind of think that if you think of Netflix with 150 plus, net subs or paid subs, and you look at their Disney's conservative guidance for their OTT service, and then you look at this bundle and you think about the things, Disney Plus, think about ESPN, and then you think of the integration of all these assets, and then you think about all that IP that's going to be coming off of all their competitors. Right. I don't really know how you know how to value this, and I'll just make the one other point about Hulu being in that bundle. I think Hulu is the answer to how to solve for live streaming. That's the one thing that we have not seen on these platforms yet, and that's going to be really important as consumers start to cut the cord, because that will be the missing piece. It's one thing to go back for Guy to watch Avengers Endgame 6 times or something like that. It's another thing to get whatever that live content that a lot of content creators are producing that's ephemeral, and that's the world that we live in right now. So to me, that's the thing I don't think you can value. I find that bundle very, very compelling.
So when you say you don't know how to value it, you're saying that it should be perhaps more valuable than we think?
Yes.
Okay.
Yeah, and I listen, and let me tell you this. November 12th, this thing's going to launch. There's going to be a lot of analysts jumping over each other to make expectations about what they're going to do and what they're not going to do. The company's already told you that this is going to cannibalize some of that TV business. They know that. So look, if you look at those estimates, that's why it looks expensive, trading 22 times, flat EPS growth. Ultimately, you should see this thing expand as earnings, as we get more earnings visibility over the next 2 years.